quick introduction. My name is Ralf Gruß. I've been with Apax for 25 years. I started off on the private equity side of our business, spent a bit of time in Asia. I'm now our global chief operating officer. I'm a partner at the firm, and I've been looking after our listed trust for the last 15 years or so.
Bonjour. J'excuse mon français n'est pas si bon, so I'm also happy that we do it in English. Cyril Wipfli, partner at Partners Group. I started 25 years ago. And this product we talk about is 26 years old, so it's actually interesting to discuss with you the opportunities. And I will talk a little bit about Partners Group, but also development of our product range, because I think it mirrors a little bit what's happened in the broader private equity space. And I'm sitting here because I was actually the CFO of Partners Group. As the group, we are also a public listed stock, so you can actually buy also shares from the holding mothership, the manager, and so I had experience with talking to shareholders in the public market world. So I'm one of the very few people at Partners Group who actually knows both worlds, the public world and the private world.
So why are listed private equity trusts a good model? I mean, what are listed trusts? Listed trusts are, as we said at the beginning, they're effectively public companies. So they're listed on recognized stock exchanges. Our fund is listed at the London Stock Exchange. They're closed-ended vehicles. So as an investor, you buy shares and you can sell shares on a daily basis, which to me is the first benefit that you have as an investor. You have daily liquidity. So that's the first one. You can go in and you can go out of the investment essentially at any day, where the stock exchange is open. The second, again, from an investor perspective, you can scale your investment, depending on how much you want to invest. Again, if you compare it to the private side of the private equity investment opportunities, here getting into private funds usually, requires quite a significant investment to be admitted into private equity funds, so the private equity funds. Again, different to a listed private equity trust model, where essentially you can buy one share, and depending what the share price is, you can start with a very small investment, and then you can scale your investment side depending on your appetite. And then the third advantage I would mention is that, if you decide that you want to be exposed to private equity, again, if I compare it to the private side of the model, it takes quite a long time to build a diversified portfolio. I mean, usually if I look at our private equity business, we launch our global private equity fund every 3 to 4 years. So for you to get diversification over portfolio companies, over vintages, it takes a long time to build up that exposure. Again, very different to the listed private equity trust model, where if you buy a share, you immediately get exposure to like a fully invested portfolio, which is diversified across industries, across sectors, across vintages, and also companies in the portfolio. So I think the model has a number of advantages. What I've just mentioned for sure is an exhaustive list, but the ones for me to highlight it's the daily liquidity that you have as an investor. Second, it's the scalability of your investment amount. And then third, you get immediate diversification by buying into a portfolio which is already invested.
Yeah, so our company, Partners Group, was started in 1996, and the private equity industry started in the 80s in the USA. And as you know, the traditional structure was a limited partnership structure, and the traditional minimum ticket size was 10 million, and it was a capital call drawdown mechanism. And then in 1999, when Partners Group was founded, we realized we need to be more innovative to come up with a structure like this. So the first product was actually Castle, which was a 300 million IPO, a Swiss stock exchange, which looked like a stock, so people could buy it out of their public equity allocation. But the 300 million IPO proceeds were used to make a private equity portfolio. The second product in 1999 was actually back then called Princess, which is now Partners Group Private Equity Limited. And And this was a convertible bond because we realized that clients actually have a bond allocation. And so because back then nobody had a private equity allocation. So Partners Group Private Equity Limited started its life in 1999 as a convertible bond, was then 10 years later converted and then listed at the Frankfurt Stock Exchange. But then we realized that the music is playing in London Stock Exchange for the listed private equity world. So we had a dual listing, but in the end decided to consolidate. So it's now only listed at the London Stock Exchange. But it's a very interesting product because it is actually the oldest product that is still alive at the Partners Group. But it still has the newest technology in a sense because the capital call distribution mechanism is actually not so suitable for high net worth individuals. And nowadays everybody wants to actually cater to the needs of high net worth individuals who are not happy with 10 million investments into funds and then have the capital call distribution, which takes a long time to diversify. So the new technology is now evolving is this semi-liquids, which everybody also calls an evergreen. So you have a Luxembourg SICAV structure. We have 150 billion of assets under management at Partners Group, about half of that in private equity, about half of that, so 40 billion in these listed, not listed, but evergreen structures, semi-liquid structures, which you can go in and out at NAV every month or every quarter. Now the problem is managing these assets. In the end, it's still an illiquid asset class. We're holding the assets for 4, 5, 6, 7 years. So in order to offer some liquidity, just means you also have to manage these liquidity. There are certain ways how you can do this. And the Partners Fund, for example, is a multi-asset class fund, so investing also in real estate or infrastructure or debt and private equity. Or we have another fund called Global Value SICAV, which invests also on the debt side. You always have inflows and outflows, you always have a cash dilution. So in the end, the performance of such an evergreen structure has to be a little bit lower than a fund which is listed and is a true evergreen. So if you actually have a company which is listed at the stock exchange, you cannot have outflows. So which means you as a manager, you don't need to be prepared for outflows. And we can be fully invested because we also have a little credit line which we can use to bridge distributions from exits with new investments. So in a sense, for me, that is now actually the true evergreen structure. And for supply-demand imbalance reasons, you can even buy the same content at a discount to NAV compared to the other structures.
Yeah, so Apax Global Alpha is essentially is the listed trust which invests in our private equity business. So what you get as a shareholder in Apax Global Alpha, you get exposure to all the private equity deals that we do as Apax across the world. Now the way the fund is structured is that the fund Apax Global Alpha, I call it the trust, is a limited partner in the private equity funds that we launch. So whenever we launch a new private equity fund, Apax Global Alpha would become an investor in that fund, and by being an investor in that fund, gets exposure to the underlying portfolio companies. So that's the technical side of it, which is probably the boring side of it. How do we make money out of this, which is the more interesting piece. So as Apax, we've been around for 50 years. Our buyout strategy is a global strategy. We are extremely sector focused. We've always thought about our investment approach as a sector focused approach. We exclusively focus on 3 sectors. We invest in tech, we invest in services, and we invest in internet consumer. And the investment strategy that we've deployed now for many years is what we call the hidden gem strategy. You can see there was a bit of marketing involvement in labeling that strategy. But at the core, what the strategy is that we say we use the sector expertise that we've built over these decades to identify companies within our target sectors which operate in attractive categories, so categories that have tailwinds. There's no reason to swim, against the river, that have tailwinds. But then we aim to buy companies which are not the fully finished products yet. We don't do turnarounds, but we want to buy good companies where we see operational improvement potential. And then essentially, we use and leverage the expertise that we've built in these sectors to work with the management teams to improve those businesses and essentially transform them, from being a good business into a great business. What's the benefit that we see in that strategy? I mean, first, and the numbers prove that, we can buy companies at more reasonable multiples. Nothing is cheap, but more reasonable multiples, because these companies aren't best in class when we buy them. Second, value creation very much depends on operational improvements. Our strategy is less driven by financial market tailwinds. And then third, quite often get the question saying, when you model your returns, do you assume a multiple discount? Again, if you look at our numbers, we usually have a premium on exit versus the peer, versus buying at a discount to peers on the way in. Why is this? Because the company that we sell is a better company on exit than it was on entry. So a global strategy, what do you get as a shareholder in the trust in Apax Global Alpha? Exposure to a global buyout strategy, that's the core of it, with a strategy to buy, good companies in attractive sectors, with operational improvement being the key value driver, and then, with the intention to sell them at, premium multiples when we exit.
Yeah, so if you invest in Partners Group Private Equity Limited, you invest into all the private equity direct investments which Partners Group as a platform is doing. And that is important to understand. Partners Group as a platform is a 150 billion assets under management shop with 1,800 employees with 21 offices worldwide. And our baseline is built differently to build differently. And the build differently we mean is that nowadays buyouts is not a business anymore where you can leverage up companies, and it's not financial engineering, and it's not so much buy low, sell high, multiple expansion, but it's more about value creation. So we really want to create value, but that's probably what all the managers will tell you. So that's probably not so differentiating. But the build differently part is actually that I think when I was the CFO, I was asked to actually change roles to portfolio management, and at the beginning I said, what the hell? I mean, I'm happy as a CFO. Why do I need to go to portfolio management? And then I realized that our clients, they have changed the needs, that they actually like to build portfolios themselves. And so we started to have these segregated accounts, these mandates. So we have an approach at Partners Group which is pretty unique. Some of the managers, they have a strategy that you have a Latin America team managing the Latin America fund, the Chinese team is doing the Chinese fund, the North American team is doing the North America fund, the Western European team is doing Western Europe, and then you have different returns depending on the teams. But at Partners Group, we also, of course, have the specialized teams. We also have verticals. We have consumer and goods and biotechnology, healthcare, blah, blah, blah. But we also have a global investment committee who then makes an investment decision. And when we, as a platform, we like an investment, then we allocate it pro rata to all the products and mandates. And so, although private equity limited, this product which we talk about is only 1 billion in assets under management, it has a pro rata allocation to all the investments we as a platform are doing. So that's a very fair way of allocating the investments. So whether you're a 100 million or 200 million or 300 million mandate client as a pension plan, or whether you are a high net worth individual investing 10 euros, share price is 10 euro per share, so even with 10 euros, you actually get a full allocation to all the private equity directs which we do. And it's a very highly broadly diversified portfolio, over 100 private equity direct companies. And nowadays it's also basically 100% Partners Group. Back in 1999, nobody knew what Partners Group is, especially in Germany. They like diversification. So in 1999, it was a fund of fund. But then in 2011, we realized all the clients who like the product, they like it because of us, because of Partners Group. And so in 2011, the strategy was changed to a 100% private equity direct portfolio. Now we're at 99%, so almost there. But it's going forward 100% private equity directs of Partners Group as a platform.
We keep the sequence. Yeah. Okay. So let me start first. I mean, fees. The reason it's a cost-effective way, and I can talk about our fund, Apax Global Alpha, and so I can comment on their fee structure, obviously, is that there is no layering of fees. So there is, on the private equity exposure that is in Apax Global Alpha, there is no additional fee level at the level of Apax Global Alpha. There's a lot of discussion, and I've, speaking to shareholders and others, following the sector, there's a question, the layering of fees in the model. There is no layering of fees. So there is no fees at the level of Apax Global Alpha on the private equity investments. What Apax Global Alpha does, and I go back to what I said earlier, it's a limited partner in our underlying private equity fund, so it pays the same level of fees and carried interest that other similar sized investors pay in the underlying funds. Now I've said similar sized investors, that's an interesting and important point, as you might imagine, the more sizable an investor becomes in a limited, in a private equity fund, the more attractive the fee rates can become. And again, what we do through Apax Global Alpha, we pass that benefit on. Again, because there is no fee level at Apax Global Alpha. Even if you invest a much smaller amount as a shareholder in Apax Global Alpha, you get the benefit of Apax Global Alpha being a large investor in our private equity funds. So it's a very efficient model to invest in the private equity class.
If you look at Partners Group Private Equity Limited, as I mentioned, if you look at the total expense ratio last 15 years, it actually came down all the time, because I mentioned in 2011 we actually had a double fee layer because we were investing in other funds. But in the meantime, you don't have that anymore, so it's much cheaper from a total expense ratio point of view. And also, if you look at the management fee, it's 1.5% on NAV, for example, and for this product, which means on fully invested, which is lower than the typical private equity product at Partners Group, which is 1.5% on commitments. So here you actually participate in a portfolio which is already fully invested. You don't need to wait for a couple of years to be fully invested. And the performance fee rate is actually with 15%, also 5% lower than the typical 20%. So if you buy a normal product at Partners Group, it's 1.5% on committed, 20% the performance fee, and this one is 1.5 on NAV and 15% performance. And no double fee layer anymore because it's now 100% direct. Yeah, I'm always honest, so I'm also honest in this question. There are different opinions. So some shareholders, for example, in Switzerland and in Germany, they say it's actually a waste of time and money because they think it's our product, we raised it, we structured it, we were investment manager, you don't need actually a board. And this is some of the clients. But there are other part of the clients, and maybe it's 50-50 to be honest, who then says, no, actually we like to have a fully independent board. And they see that that's maybe what are the costs involved of that. It's maybe 4 basis points. And they see, because I rather invest these 4 basis points, but then have like an additional layer of scrutiny that you have a board which represents the interests of the shareholders and not the interests of the manager. Because I do see there could be a conflict of interest. So for example, if we would sell out of a 1 billion portfolio, we sell half of that at a discount to our own funds, and of course that would be a conflict of interest. And it's good to have an independent board who can stop you doing this. Of course you would never do this because it's our only product which is public, and so everything we do is to protect our brand as a firm. This is the of utmost importance. But some shareholders, they like that additional scrutiny by 5-6 independent board members experience and challenge us. And for example, our board managed to lower the fees. So they managed to convince us that we actually lowered the fees as of 1st of January. So I do think there is a benefit.
Yeah, I'm very happy to go there. But maybe before I go there, I mean, just echoing what Cyril says, I think there's probably mixed opinions. I'd say in particular, in the UK, where most of the shareholder base sits, there is a clear desire to have an independent board and 100% clean corporate governance. Topics like protecting shareholder interests, supervising and monitoring what the investment manager does, which is, I would probably say, really, it's the majority of the listed private equity trusts have independent boards by now. Maybe there are some that have like 1 or 2 board directors which belong part of the GP, but from a governance model, I'd say if I look across the funds that are listed, you'd mostly see independent boards. So you've asked about the history. Again, I was cautious on that question that people don't think it's like history 101 back at college, which this shouldn't be the case here. So our fund was, our fund isn't that old like as the Partners Group fund, but our fund was historically an internal fund, where we were managing money of the partner group and our employees. Same strategy. So essentially we had our internal pot of capital, with which we invested in our own private equity funds. And that model, for us, historically was very attractive. We generated very attractive returns. So we took the decision in 2015 to take that fund public. So the history of the fund is actually internal partner money, which means today, if you look at the shareholder structure of our trust, there is a significant part of the shareholding, which is owned by either people that work at Apax, the partners at Apax, or always, as time has passed, some of those partners have meanwhile retired, so retirees. It's if you take it together, it's around 40%, which is held by those two groups. Which, again, as an external investor, that obviously creates huge alignment as we are sitting 100% in the same boat, with the external investors being significant shareholders in the fund.
Yeah, it's a dangerous question. I wrote my PhD thesis about valuation, and so I love to talk about this topic for hours. No, I think the industry really has developed. In the 80s, when the industry was invented in the USA, private equity valuations were not important because you had a fund which was locked for 10 years anyhow. The management fee was on committed, not on NAV. The performance fee was on exits, not on NAV. So the NAV was not important. So in the 80s, nobody put a lot of love, nobody meaning the managers did not put a lot of love into the NAVs. But the times have changed, first from US GAAP and IFRS, true and fair value. So you were asked to be closer and closer to the real exit. So it was not allowed anymore to have a company you buy for 100 and then 5 years later you sell it for 200. You're not allowed to keep it at 100 for 5 years. But you needed to develop a model that you write it up from 100 to 500. When you then sell it at 500, then you actually have not a jump in that quarter. And then came the semi-liquids like we have now. So we have now liquid, semi-liquids which go in and out at NAV every month. So it would be totally unfair if we are too conservative, for example, with the valuations, and then somebody's buying in January and somebody's selling in January, then the buyer actually bought too cheap. And the seller did not get enough money. So you really need to be on the spot. So our valuation team, which I think does a fantastic job also with mark-to-market, they look for every single company, they look at a benchmark of companies which are public, and then we compare the public multiples. So they do a good job of analyzing all that. And so the valuations are now so good that I think they get angry when I tell them they're conservative, because they always say, no, I'm not allowed to be conservative. I need to be true and fair. It needs to be perfect. Now, if you then look at how they done the last year, for example, all the exits we did last year, in the end were 37% higher than what we had in the book. So in the end, they were a little bit too conservative. But in hindsight, you're always smarter, and of course, you also sell the good companies. So from that point of view, I think they did a good job. But what I cannot understand is, and then probably then the next question is, why then the discount is so high? If we say the NAV is 100 and you sell the company at 137, but you trade at 35% discount, which means you trade at 65. And 65 to 137, that's like a 50% discount. And this is not justified anymore with the high level of sophistication of the private equity valuation approach we have nowadays.
Yeah, so it's very similar. It's very similar. I remember the good old days, in terms of keeping like investments at cost unless something material changed. But that's probably 20, 25 years ago. Yeah, that's like 20, 25 years ago. The model has become a lot more sophisticated nowadays. The model we use is, I assume, very similar again to the Partners Group model. We look at comparable transactions and multiples, public comps. So it's a comps-based approach. It's not like a DCF, where you would have, like judgment in terms of what terminal values are. You compare your portfolio companies across to public peers or recent transactions that have happened, and that forms the basis of the valuation, which again, just echoing this, is a very transparent, very transparent way of valuing those companies. Nevertheless, if you look at the longer term track record, you do see, what we call uplifts and exit, meaning that, transactions happen at a premium. Congratulations, 37% is a very impressive number. So, well done on that one. I think over the long run, I probably expect those uplifts to be more or historically they've more been in the, around the 20% level, plus minus. Obviously, always depends a bit on where you are, the type of company, what the valuation is achieved at the end. But there is a track record of uplifts around these levels over the long term.
Great, and maybe continue with your, can you put the current trust discount on NAV into an historical perspective, and discuss what are the causes for that discount in your view? It's the 100 million question.
Exactly. Yeah. Well, if there was a single reason, that would be useful. So the discounts are, they're not that high as they've been at the peak of the GFC, but that was obviously a very, very different set of circumstances. What we have seen across the listed trust sector and the private equity trust sector over the last 2-3 years, essentially as rates went up, is that the discounts widened quite significantly, and I would say private equity trust at the moment 30 to 40% discount is probably where these trusts trade. There's a number of market factors that have played into this. One reason, for example, being rates going up. A lot of investors have held these trusts for the income that they distribute. That's not only the private equity trusts, and have just reshifted their allocation to fixed income. Other reasons here, there's consolidation around multi-asset managers that plays a role. Again, the sector is very much driven by UK investors at the moment, so you need to think about flows into UK equities more generally. So there's a longer range of market factors that have caused these discounts to widen. Cyril, any?
Yeah, so I also don't know the answer, otherwise we would not trade at 35% discount ourselves. But I definitely can say it must be a supply-demand imbalance. And I think just most people just don't know. So actually thank you that you're here and listening about the UK investment trust universe, because in France they don't know about this. The same thing in Germany. Nobody knows about UK investment trusts in Germany, or also Switzerland for that matter. It's a niche market, so there is very little demand because people actually don't know about it. And so whenever you have a seller, it's a supply-demand imbalance. I also have when I was the CFO of Partners Group Holding, then I had the problem that I had a lot of asset managers who went in and out of the stock all the time, and I wanted to have an investor base which was very long-term. So I was trying hard to have an investor base which is very long-term. Now at Partners Group Private Equity Limited, it's almost a little bit the opposite. All the shareholders which we have, they are long-term holders, and some of them even proud that they hold it since 1999, which is great, thank you very much, but there's no liquidity. I need some guys who actually trade, who sell and buy, just to have daily liquidity. So I think this is also a problem in these vehicles, that a big chunk is always held by long-term holders who are actually not reacting to news. When Andrea and I publish a press release or so, which doesn't change anything usually. It's not going up, it's not going down. The market is not efficient. So that invisible hand, that the market economy is always perfect, I think for this part of the market, it's not playing at the moment.
Yeah, capital allocation. So capital allocation for the fund, maybe just to set the frame, how I think about it, what is capital allocation? It's essentially the decision for the board, if they have an incremental euro to invest, whether they invest it in the portfolio, so new private equity opportunities, whether they pay it out as a dividend, or whether they buy back a share. That's capital allocation, from the perspective of the trust. Now, Apax Global Alpha, from the very beginning, since its IPO, it has a policy to distribute dividends. Initially, the dividend policy was fixed at paying 5% off NAV every year. That was slightly adjusted by the board last year. It's now fixed at 11 pence per share, which is broadly similar to the 5%. So it's, from a capital allocation perspective, the fund is paying significant amounts of cash back to shareholders, through dividends. I mean, 5%, if you do the maths at the discounts at which these funds currently trade, the dividend yields investors are getting, from the trust are very significant. In addition to that, and this is something that the board changed last year, introduced share buybacks. Share buybacks as an additional mechanism of, as an additional tool in the toolkit of capital allocation to say, the company can also buy back shares. And here the logic is a very, a simple one to say, if shares trade at a very steep discount, then the decision for the board is to say, what drives shareholder value? Is the incremental dollar that you have better invested in the private equity portfolio, which generates a compounding attractive long-term return, or is it better invested buying back shares, that trade at a significant discount? It's obviously a judgment involved here, and that's, again, comes back to the decision, what we've discussed earlier, why there is an independent board, but at some level of discount, it becomes more attractive for shareholders to say, even though private equity returns are very strong in the long term, to say, I'd rather generate this one-off return by investing my incremental dollar in a share buyback to create shareholder value and NAV accretion per share for shareholders than investing in a portfolio. So from an Apax Global Alpha perspective, it's all three of it. I mean, obviously, the purpose of the fund, and we're investing in private equity that creates long-term compounding returns. It's a very high dividend, that creates like a constant stream of cash back to investors. But then the board also takes an active role or takes its role in shareholder value creation by saying, if the discount is very wide, we can buy back shares to generate this one-off NAV accretion.
Yeah, very, very similar. Nowadays, we also have a very clear capital allocation policy. I have to say we were not that clear in the past. I think that was a mistake. We've in the past, every 6 months, depending on cash flows, we actually decided how much dividends we pay. But we realized clients don't like that. Clients want to have visibility. They will need to commit either to capital gain or your dividends. If your dividends, then be please steady dividends. And so we came up with a formula which basically looks at the distributions and says, okay, the top priority are now 5% on NAV dividends, which is a 35% discount at the moment. Unfortunately, a 7% dividend yield, but that's not what we target. We target the 5% NAV. But if you pay the dividend, so that is clear, we're predictable, so we pay the dividend, and after that, then we can think about share buybacks. But we wanted to make it clear that actually first is dividends, then second they can be share buybacks, and then of course, then thirdly is the new investments. But you need to have distributions for that. But we basically, our capital allocation policy is a formula. You can look up yourself, it's public in our presentations, so that you know exactly how much of the capital is being reinvested. But it's an evergreen vehicle, so you need to have actually distributions for that. So we get a lot of questions, why did you do 100 million share buybacks now? They said, yeah, because the portfolio is 100% fully invested, so I actually have zero cash, and I don't think you want that we draw a 100 million credit line to buy back shares. That makes no sense. So that's why first you need to have distributions, and then when you have distributions, then you can think about what to do. We committed fully to dividends. A 5% dividend on NAV or 7% dividend yield is like roughly half of the performance of the product. I mean, the last 10 years, it was 11% was the performance on NAV per annum. It was 11% per annum on share price, basically same thing in the long run, share price and NAV. and then 5% or 7%, depending how you look at it, is a little bit half. So basically half of the value creation we reinvest and half we pay out as dividends.
0 to 40%.
Yeah, same thing. We traded once a little bit at a premium, but unfortunately it was not long enough for us to do a capital increase. Because of course that would be the dream, that you trade at a premium and then you do a capital increase. Everybody dreams about that, but unfortunately, so a little bit of a premium. And in the highest, I would say normal, also in a normal year, if you have a bull market, it's 5 to 10% discount to NAV. In a bear market, it's 20 to 30% discount to NAV. And on average, it's maybe 15% or something. But that you are 35%, us or the whole industry, 30, 40% is very unusual. So I've only seen that in global financial crisis or COVID. But COVID, for example, was a very, very quickly V-shaped recovery. It was a couple of weeks and then it spiked back. So very attractive to buy.
Thank you so much. Well, I think we should break it off now. And maybe we can thank our presenters. Very good.